I think this is the most significant financial crisis in the post-war period.
There are fears the sell-off will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
What kind of recipe is that? Overall, that's a recipe for recession.
With some economists calling now a 40% recession chance in 2025, GDP expectations being in the negative for the first quarter, and jobless claims in the rise, it seems like heading into a recession slowly becomes a reality. But what does the Fed actually uses as an indicator for the economy? What are other indicatives that a recession may be coming up? This is Airspeed Trades. Hope everyone is doing okay out there. Let's dive right in. The Fed's favorite indicator, well, is no other than a tool that hasn't failed since 1966. It's the 10-year 3-month difference yield, also known as the spread. You can check out the Fed's website and see the graph for yourself. Let's say investors are not very confident about the market in the short term. Things are turbulent and there is not a clear, at least positive outcome for the short term. So therefore, investors want to be putting their money on the long run, right? So they're going to be getting more of these 10-year treasury bonds. That would increase the demand of it. And as an effect, it will drive the yield or rate of return that the government pays for the money that you have lent them lower. That's how bonds work, right? And the opposite for the short term, right? So now it becomes easier to interpret the difference yield graph. You got more demand for the 10-year, causing the yield to go low, to lower, and less demand from the 3 bond, causing its yield to rise. Less demand for it, so the government wants to pay you more for that if you put your money in. So that difference in number, that difference is called the spread. So the bigger the spread, the bigger the difference between, you can say, people betting on long term and short term, right? Economic prosperity. So let's see. So in previous recessions, which are depicted in gray, these are the recession areas, you can see that the yield actually previously to that turned negative and then turned to the negative, meaning that there were more people betting on the long term than the short term, becomes negative, then goes inverse again into the positive, and then you have a recession. Now you can see here that it happened in 2001. You can see a very clear negative side in 2000, prior to 2008 as well, and in 2020, right? And now look at this. Here's where we are right now. Massive side on the negative, and just came up to the positive side, right? And jumping up and down in this area. Another point that is worth mentioning is that prior to the 90s, it wasn't really very obvious and very clear for the indicator to show right before the recession. But that is because the Fed didn't really adjust the overnight rate like they do nowadays. So now when they talk about the overnight rate, which is the rate that everyone talks about when Jerome Powell goes and says, hey, we're going to lower or increase rates, he's talking about the overnight rates, right? That would mean borrowing money for cheap, right? For cheaper, at a cheaper rate, therefore stimulating the economy, right? and they're slowing it if it needs to, right? By raising the interest rate, making it more expensive to borrow money, to create and develop more businesses. Another barometer of the economy is definitely GDP. GDP growth. GDP growth is very important, and you can see here that the forecast for the first quarter is not too great to say the least. So they are expecting a shrink of 1.5% for the first quarter. But worth mentioning as well that the tracker is volatile, so it could change. However, you take that into account with other indicators, other data that you have there, and then it starts showing a pattern like, okay, well, seems like growth is slowing down, right? Actually, this week on March 27, so this Thursday, we will have at 8:30, we will have the GDP growth for the first quarter. It's forecast 2.3 from a previous of 3.1. So it's a considerable drop from last quarter. So keep that in mind. At 8:30 Thursday, you may expect the market possibly doing a pullback, a small pullback, but we shall see. Another indicator you can look at is how the house market is doing, right? Nothing new, not a secret. Everyone looks at these data points to check on the economy. So you can see that pending homes, which is what I like to look at, pending home sales are down 5.2%. Well, ultimately, I don't think it's a question of if, I think it's a question of when. When a recession will happen, will it be this year, later this year? People are saying later, probably this year, you'll see a recession. I mean, you take a look for yourself here. When it goes positive on, let's see, to August, when positive right there, you can maximize this and see when we enter a recession. Once we were on the positive, we were dancing around here in July of 2007, and it took half a year to get into a recession, right? So we could be also in that transition of half a year to a year. We could be in that transition here. Let's see. Maximize once it goes into the positive, December to February, couple months, right? And do we no that one, this one, positive, and very soon after, couple months as well, get into that recession region. All right, well, I wanted to share with you the indicator and how to interpret it. So now we know what indicators I use. I look at unemployment, the spread between the 10-year and 3-month, and GDP, and the housing market. It's always a good indicator. Thank you for watching. I'll be dropping another video on how to manage your money during the recession. Drop a like, subscribe, and ring that bell. Have a wonderful day.